Okay, let's dive right into this explainer. Because look, if you're an Indian living in the UK and earning rental income or FD interest back in India, a major tax change has just happened that is absolutely going to affect you. The historic UK non-dom status, it's gone. For anyone managing a cross-border life, this is a literal game changer in how your wealth is treated.
For years, many UK residents relied heavily on the non-dom regime to manage their wealth. Under those old rules, foreign income often just wasn't taxed in the UK unless it was actually brought into the country. So, if your Indian rental income or mutual fund gains stayed in India, your UK tax exposure was pretty much limited. Back then, the only question HMRC really cared about was, did you bring the money to the UK?
But as of April 6, 2025, the UK completely abolished that regime. They entirely flipped the script. The question is no longer, did you bring the money to the UK? No. The new question is simply, did the income arise? HMRC now looks at your worldwide income the moment it happens, completely regardless of where that money is actually sitting.
So to make sure you're protected, we're going to break down exactly what this means for you. We'll quickly cover the end of non-dom, the new arising basis, how this hits your Indian bank accounts and rental income, the lifeline of tax-sparing and reliefs, and finally, your action plan for 2026. Let's get into it.
Part 1. The end of non-dom, which was officially abolished on April 6, 2025.
Let's just start with the hard reality here. The whole concept of domicile, where your permanent home is, has been completely stripped out as a connecting factor in the UK tax system. Think about that old mindset for a second. You could sit back, relax, and know your foreign wealth was safely offshore and totally untaxed by the UK. It was a perfectly legal, highly effective way to shield your money. Well, for most long-term UK residents, that luxury, it's over.
That brings us to Part 2. Welcome to the arising basis, which means taxation on your worldwide income.
With the old remittance basis gone, the new system relies entirely on a strict residence test. As you can see here, worldwide income is now taxed exactly as it arises. Now, there is a very specific 4-year FIG regime that stands for Foreign Income and Gains, but that's strictly for new arrivals who have been non-resident for 10 years. For everyone else, you are now taxed in the UK the absolute moment your Indian investments make money.
And look at the assets we're talking about here. Your Indian rental income, FD interest, dividends, and capital gains from things like property sales or mutual funds, all of these may now require active reporting to HMRC. And remember, this is true even if the money never leaves India. You could literally never transfer a single rupee to a British bank, and you'd still owe the tax.
Moving on to Part 3, taxing Indian bank accounts. Let's look at the reality for NRE, NRO, and FCNR accounts.
Okay, this is where I see some of the biggest and, honestly, most expensive misconceptions. A lot of people mistakenly think, hey, my NRE and FCNR interest is tax-free in India, so it must be tax-free in the UK, right? Nope. Look at that UK tax status column. Under the arising basis, that interest is fully taxable in the UK all the way up to your highest income tax bracket. And for NRO accounts, those usually have a 30% withholding tax in India, meaning you've got to carefully declare them to manage your foreign tax credits and avoid getting double taxed.
I really want to highlight this specific point. A higher-rate UK taxpayer suffers no Indian tax liability on any interest earned in an NRE account, but is liable to a 40% tax charge in the UK. That is wild, right? It perfectly illustrates the crazy tax asymmetry you're facing. India is trying to give you an incentive to invest back home, but the UK taxman, he's just swooping in to collect it all if you aren't actively managing things.
Section 4, your Indian rental income. We've got new rules, which means new math.
So if you're a landlord back in India, the way you calculate your taxable profit has to change right now. India is actually really generous here. They give you a flat 30% standard deduction to cover repairs and maintenance. But HMRC, they don't care about that. For your UK tax returns, you've got to calculate your rental profits strictly using UK accounting rules. That means you can only deduct actual, documented allowable expenses, or you can just take a flat £1,000 property income allowance. But the bottom line is, UK rules now apply to your global properties.
Part 5. Tax Sparing and Reliefs. This is your lifeline for double taxation.
Okay, take a breath. I know this all sounds completely daunting,
But there is some good news. The India-UK tax treaty and foreign tax credits can actually help prevent double taxation. Specifically, there's this amazing thing called tax-sparing relief. Remember how we said NRE interest is tax-free in India but taxed in the UK? Well, tax-sparing gives you a notional 15% tax credit against your UK bill. It basically acts as if you did pay 15% tax in India. It's the UK's way of honoring India's tax-free incentive.
But, and this is a massive but, you have to watch the clock on this. Tax-sparing relief vanishes exactly 10 years after you open that NRE or FCNR account. Once you hit year 11, boom, the UK taxes it fully without that 15% credit. Also take a look at the Temporary Repatriation Facility, or TRF, on the timeline here. If you have old, pre-2025 income sitting offshore, the TRF gives you a super brief window, just until 2028, to bring that money into the UK at way lower tax rates of 12% and 15%. Definitely a strategic window you should look into.
Finally, Section 6, your action plan for 2026. How to prepare before those HMRC nudge letters start arriving. Look, thanks to automatic data sharing between Indian banks and HMRC, ignoring your Indian income is literally no longer an option. So, here are the 3 steps you need to take today. 1, dig up those exact account opening dates so you know when your 10-year tax-sparing relief is going to expire. 2, tell your Indian banks about your UK residency and submit a tax residency certificate. This drops your NRO withholding tax down to 15%, which perfectly lines up with UK credits. And 3, redo all your rental calculations using strict UK rules. Ultimately, the burden is now 100% on you to proactively disclose your worldwide income. The days of quietly leaving wealth untaxed offshore are just totally behind us. So, isn't it time you audited your Indian portfolio before a nudge letter from HMRC forces your hand? The rules have changed, and it's time to adapt. Thanks so much for joining me on this explainer. Stay proactive out there, and I'll see you in the next one.